Most retail traders think the market is about indicators and strategies. Banks know it's about liquidity, psychology, and patience. While you chase breakouts, institutions quietly engineer them. This isn't bad luck. This is how the game was designed, and today, Rabbi David exposes the truth no one tells retail traders. Most people who enter the markets believe trading is a technical skill. They believe that if they learn enough indicators, watch enough videos, and copy enough strategies, consistency will eventually arrive. What they don't realize is that the market is not a test of intelligence. It is a test of emotional control. And this is where the first divide begins, not between beginners and experts, but between those who react and those who wait. Retail traders are conditioned to act fast. The moment price moves, they feel pressure. A green candle creates excitement. A red candle creates fear. A small pullback feels like danger. A sudden spike feels like opportunity. Every tick triggers emotion, and emotion demands action. This constant need to do something is not accidental. It is learned behavior. From the very beginning, retail traders are taught that activity equals productivity. More trades mean more chances. Faster entries mean better timing. Sitting on hands feels like wasting time. But the market rewards the opposite. Professionals understand something most retail traders never truly accept. The best trades come from waiting, not reacting. Waiting for imbalance. Waiting for liquidity to build. Waiting for the crowd to commit emotionally to the wrong idea. While retail traders stare at charts, searching for confirmation, institutions observe behavior. They are not interested in predicting the future. They are interested in exploiting predictable human responses. Fear and greed are not flaws in the market. They are the fuel. Retail traders are driven by the fear of missing out and the fear of losing. When price moves quickly, they chase. When price pulls back, they panic. When price consolidates, they get bored. Every emotional reaction creates urgency, and urgency leads to poor decision-making. The market does not punish lack of knowledge first, it punishes impatience. Professional traders do not feel the same urgency. They are not emotionally tied to individual trades, they do not need constant validation. Their confidence comes from probability, not prediction. They know that missing a trade is irrelevant, but entering a bad trade is costly. So they wait. They wait while retail traders overtrade. They wait while emotions peak. They wait until price reaches levels where reactions are guaranteed. This difference in mindset is the real edge. Retail traders feel the market is alive and attacking them personally. Professionals see the market as a system responding to order flow. One reacts to movement. The other anticipates reaction. And this brings us to the second illusion, the belief that charts exist to forecast price. Most traders are taught that charts are tools for prediction. Patterns are seen as signals. Indicators are seen as guides. Support and resistance are treated like invisible walls that price must respect. But price does not move because of lines on a chart. Price moves because of orders, and orders exist where emotions cluster. Charts do not predict where price will go next. They reveal where liquidity already exists. Every obvious high, every clear low, every textbook pattern, every trendline breakout attracts attention. Attention brings participation. Participation brings orders, and orders create liquidity. This is not coincidence, it is structure. The more obvious a level becomes, the more people place stops there, entries there, exits there. What retail traders see as confirmation, professionals see as inventory. Liquidity is not something mysterious. It is simply the availability of buyers and sellers at specific prices. Large players cannot enter or exit positions randomly. They require volume. That volume does not appear in empty space. It appears where traders are emotionally committed, where fear forces stop losses, where greed fuels breakout entries, where hope keeps losing positions alive. When price approaches a well-known level, retail traders feel certainty. They believe the market is finally making sense. But certainty is dangerous, because when everyone agrees, liquidity accumulates. And when liquidity accumulates, price becomes vulnerable to sudden movement. Not because the market is evil, but because efficiency demands it. Retail traders often say the market hunts stops. In reality, the market seeks liquidity. Stops are simply concentrated liquidity. When price moves aggressively through a level, it is not chasing traders, it is filling orders. What feels like manipulation is often just execution. The pain comes from misunderstanding the purpose of price movement. Indicators make this misunderstanding worse. Indicators lag. They process past data and present it as guidance. By the time an indicator signals a buy, the liquidity has already formed. By the time it signals a sell, the move is often nearly complete. Retail traders end up trading reactions to reactions, always late, always emotional, always chasing clarity that no longer exists. Professionals do not rely on delayed confirmation. They observe where traders are likely to act, not where price has already acted. They understand that the market is not designed to reward clarity. It is designed to exploit consensus. When something looks too obvious, it becomes dangerous. When something feels uncomfortable, uncertain, or boring, it often holds opportunity. This is why retail traders feel betrayed by charts. They follow patterns perfectly, yet lose repeatedly. They respect support and resistance, yet price slices through them. They wait for confirmation, yet enter at the worst possible moment. The problem is not discipline, it is perspective. They are looking at the market as a map for direction, not as a map of behavior. Once this shift happens, everything changes. A breakout is no longer exciting, it becomes suspicious. A sharp move is no longer opportunity, it becomes a sign that liquidity is being consumed. A stop loss is no longer protection, it becomes part of a larger pool of orders. The chart transforms from a prediction tool into a behavioral blueprint. One of the most painful realizations a trader can have is understanding that most entries feel right, precisely because they are wrong. Retail traders are not unlucky. They are simply positioned on the opposite side of professional intent. Time after time, they buy exactly where larger players are distributing, and they sell exactly where accumulation is taking place. This isn't coincidence, and it isn't personal. It's structural. Retail traders are trained to see strength where exhaustion exists and weakness where opportunity is forming. A strong bullish candle convinces them the move has begun, but in reality, it often marks the end of momentum. A sharp sell off feels like confirmation of a breakdown, but frequently it is the final act needed to force emotional exits before price reverses. What looks like continuation is often completion. What feels like safety is often the most dangerous place to act. The reason this happens is simple. Retail traders enter based on confirmation, while professionals operate on anticipation. Confirmation requires price to already move. Anticipation requires understanding where traders will react before the move happens. By the time confirmation appears on a chart, the opportunity has usually passed. What remains is liquidity for someone else to exit. Every breakout that feels obvious attracts late buyers. Every breakdown that looks clean attracts panic sellers. Those orders do not disappear into the void, they become fuel. When enough traders commit emotionally to the same idea, price no longer needs to continue in that direction. It needs to rebalance, and rebalancing usually means moving against the crowd. This is why retail traders so often experience immediate reversals. They enter with confidence, only to watch price move instantly against them. They move stops tighter, convinced the market is testing them. Then the stop is hit, price reverses, and frustration turns into belief in manipulation. But nothing supernatural happened. Liquidity was collected, and inventory was filled. Professionals do not wait for confirmation because confirmation belongs to the crowd. They wait for the crowd to commit. Once commitment is visible, the path becomes clear. The market doesn't need more buyers to go up. It needs sellers willing to sell at a discount, and the easiest sellers to find are trapped buyers forced to exit. Pain creates supply. Fear creates volume. This leads to the next uncomfortable truth. The market does not reward participation. It rewards patience and pressure. Retail traders feel that being active keeps them involved. They feel that frequent trading increases opportunity. In reality, frequent trading increases exposure to emotional error. Professionals understand that most market movement exists to create bad entries, not good ones. Markets are engineered environments, not in a conspiratorial sense, but in a functional one. Large positions cannot be built or closed without opposing flow. That opposing flow comes from retail traders acting on emotion. So the market creates scenarios that trigger predictable behavior: fear at lows, greed at highs, hope in the middle. Retail traders believe they are trading price. Professionals are trading people. When price moves slowly, retail traders get bored. When price moves fast, they get excited. Speed creates urgency. Urgency creates mistakes. Sharp moves are not invitations. They are traps for those who believe momentum equals opportunity. Professionals understand that speed often signals the final phase of a move, not the beginning. This is why markets often spike violently before reversing. That spike forces late entries and emotional decisions. It clears weak hands. It creates imbalance. Only after this emotional wash does price stabilize and move with purpose. Retail traders experience the chaos. Professionals exploit it. The illusion of control is another trap. Retail traders believe placing a stop loss means they are managing risk. But a stop placed without understanding structure is simply a visible order. When stops cluster around obvious levels, they become liquidity. The stop doesn't protect the trader, it protects the market's need for orders. This doesn't mean stops are bad. It means blind stops are expensive. Protection without context is illusion. Professionals place risk where it invalidates their idea, not where it feels comfortable. Retail traders place risk where emotion tells them to, often just beyond obvious highs or lows. Comfort zones are crowded. Crowded zones are dangerous. Most retail traders believe indicators are tools of clarity. They believe indicators simplify complexity, filter noise, and reveal hidden truth. In reality, indicators are comfort devices. They smooth chaos just enough to make uncertainty feel manageable. And that feeling is dangerous, because markets are not moved by calculations on a screen. They are moved by orders being executed in real time. Indicators are built on past price. They take what has already happened, process it, and display it as guidance. By the time an indicator flashes a signal, the decision has already been made by those who move size. What retail traders receive is not information, it is confirmation that liquidity has already been created. Indicators don't lead price. They follow behavior. This is why two traders can use the same indicator with opposite results. One waits for confirmation and enters late. The other waits for the confirmation to trap the crowd, and then acts in the opposite direction. The indicator itself is neutral. The damage comes from how it is used. Retail traders treat indicators as instructions. Professionals treat them as evidence of mass behavior. Order flow does not care about indicators. Volume imbalance does not wait for moving averages to cross. Large orders do not pause for oscillators to reset. Markets move when there is an imbalance between aggressive buyers and sellers. Everything else is secondary. Indicators mask this truth by converting raw behavior into delayed signals. Retail traders love indicators because they reduce responsibility. When a trade fails, the indicator is blamed. When a trade wins, the indicator is praised. But dependency on tools creates fragility. When conditions change, indicators lag. When volatility shifts, indicators mislead. When markets compress, indicators overtrade. Professionals operate from a different framework. They do not ask what an indicator is saying. They ask who is in control. They observe how price reacts to levels, how quickly orders are absorbed, how volume behaves during expansion and contraction. They watch for imbalance, not alignment. Timing is everything. Entering too early is dangerous. Entering too late is fatal. Indicators almost always deliver late entries because their purpose is confirmation. Confirmation feels safe because it aligns with the crowd. But safety in markets is an illusion. The moment something feels obvious, risk increases. Retail traders are taught to wait for confirmation and then enter with confidence. Professionals wait for confirmation and then prepare for reversal. The same signal triggers opposite actions. One enters because the move looks strong. The other waits because the move looks crowded. This difference explains why retail traders often feel cursed. They do everything right and still lose. They follow rules, respect indicators, and manage risk, yet the outcome repeats. The issue is not discipline. It is context. Without understanding who the signal attracts, confirmation becomes a trap. Risk management is where the gap becomes impossible to ignore. Retail traders talk about risk, but they experience it emotionally. Professionals experience risk structurally. Retail traders trade to feel right. Professionals trade to survive. Retail traders want to win trades. Professionals want to control exposure. This difference shapes every decision. Retail traders increase size after wins, chasing confidence. Professionals reduce size when uncertainty rises. Retail traders seek excitement. Professionals seek stability. Most retail traders believe risk management means placing a stop loss. But a stop loss is only a location. It is not protection by default. Protection comes from placement that invalidates an idea, not from arbitrary distance. When stops are placed based on comfort, they become predictable. Predictability creates vulnerability. Professionals accept losses as operational costs. Retail traders experience losses as personal failure. This emotional attachment destroys consistency. When a loss hurts emotionally, behavior changes. Trades are skipped. Stops are moved. Revenge enters. The system collapses. Professionals do not try to avoid losses. They try to control damage. They understand that no strategy avoids drawdowns. The goal is not perfection, it is longevity. Survive long enough, and probability works. Rush results, and probability collapses. Retail traders often risk too much because they believe in individual trades. Professionals risk small because they believe in series. One trade means nothing. 100 trades reveal truth. This mindset removes pressure. Pressure is the enemy of execution. The need to be right is poison. It forces early exits on winners and late exits on losers. It distorts judgment. Professionals do not need validation. Their confidence comes from process, not outcome. When a trade fails, it is data. When it works, it is also data. Retail traders confuse risk with fear. Fear feels like danger, so they avoid it. Professionals see fear as information. If a trade induces fear, position size is wrong or context is misunderstood. Fear is feedback, not an enemy. This is why professionals appear calm during volatility. They are not brave, they are prepared. Their risk is predefined. Their exposure is controlled. There is nothing to panic about because nothing is at stake emotionally. Emotional neutrality is not talent, it is design. Indicators promise certainty. Risk management demands acceptance of uncertainty. Retail traders chase certainty and ignore risk. Professionals accept uncertainty and master risk. That is the edge. When traders stop asking indicators for permission and start asking price what it is revealing, clarity improves. When they stop seeking validation and start protecting capital, consistency becomes possible. When risk is respected before entry, outcomes stop being surprising. Most traders fail not because they lack strategy, but because they lack restraint. Tools do not save undisciplined behavior. Indicators do not override human emotion. Only structure does. Most traders believe a stop-loss is protection. They believe it is a shield that limits damage and keeps them safe. What they don't understand is that a stop-loss placed without structural awareness is not protection at all, it is exposure. It is a visible promise to exit at the worst possible moment. And when many traders make the same promise in the same place, that promise becomes liquidity. Stops are not evil. They are necessary. But ignorance turns them into weapons against the very people who rely on them. When traders are taught to place stops just beyond obvious highs or lows, they are being taught where to lose, not how to survive. Comfort is expensive. Obvious is dangerous. The market does not respect personal rules, it responds to collective behavior. Every obvious level is crowded. Every crowded level is vulnerable. When price approaches these areas, it is not being tested, it is being measured. How much volume exists there? How much fear? How much forced liquidation can be triggered with minimal effort? Once that calculation is clear, price moves decisively. What feels like a hunt is simply efficiency. Retail traders often say their stops are taken out before price moves in their favor. This is not bad luck, it is poor placement. Stops placed where everyone expects invalidation do not invalidate anything, they complete a process. The moment those stops are triggered, liquidity is released, and price is free to move. Professionals place risk where their idea is proven wrong, not where pain feels tolerable. There is a massive difference. One is logical, the other is emotional. Retail traders choose emotional comfort because it reduces anxiety. Professionals choose logical exposure because it preserves probability. This is why stop placement cannot be taught as a rule. It must be understood as a function of structure, timing, and intent. A stop should sit where continuation becomes irrational, not where fear becomes unbearable. Most traders never make this shift, so they keep donating liquidity to those who do. The market rewards those who think in probabilities, not those who seek certainty. A trader who fears being wrong will always be wrong at the worst time. The market does not punish mistakes, it punishes attachment. The moment identity is tied to outcome, discipline collapses. This leads to the final transformation. The moment a trader stops seeing themselves as part of the crowd. Most people in the market are unknowingly playing the same role. They consume the same education. They follow the same strategies. They react to the same signals. They place risk in the same places. Uniform behavior creates predictable outcomes. The moment a trader steps outside that uniformity, confusion appears. Trades stop feeling obvious. Entries feel uncomfortable. Patience feels unnatural. This discomfort is not a warning, it is a signal that conditioning is being broken. Thinking like the crowd feels safe because it is familiar. Thinking independently feels dangerous because it removes emotional shelter. But safety in numbers does not exist in markets. The crowd is the fuel, not the beneficiary. When a trader stops asking, "What should I do?" and starts asking, "What will most people do here?" perspective shifts. That single question separates reaction from strategy. The goal is no longer to be right. It is to be positioned where reaction creates opportunity. This is not about becoming aggressive or reckless. It is about becoming selective, fewer trades, better locations, less emotion, more observation. When the need to trade disappears, clarity improves. When urgency fades, timing sharpens. Most traders fail because they try to win. Professionals succeed because they try not to lose. One mindset chases outcomes. The other protects process. When process is protected, results follow naturally. The market does not reward effort. It rewards alignment with behavior. When a trader stops competing with others and starts positioning against predictable emotion, everything changes. Losses become smaller. Wins become calmer. Confidence becomes quiet. This is the final truth: the market does not defeat traders. Traders defeat themselves by refusing to see the game for what it is. The moment a trader stops being the crowd, they stop being liquidity. That moment is not loud. It is not exciting. It feels lonely. It feels slow. It feels boring. But it is the moment consistency becomes possible, because the market was never designed to reward excitement. It was designed to reward those who understand why excitement exists.